Thank you so much everyone for joining. And today our presenter, Mr. Muhammad Ibrahim, he was supposed to present this webinar, but due to his personal emergency, he is not able to deliver himself. So I'll be delivering this webinar on his behalf as well as on Institute of Financial Accountants' behalf. I'm going to share my screen. Hopefully screen is visible to everyone and you can hear me very well. Okay, so I believe I have introduction with everyone. Myself is Salman Ehsan, and I am representing Institute of Financial Accountants of UK as a regional director as well as the fellow member. And I'm having around 15 years of experience in with regards to IFRS conversions and compliances, as well as merger and acquisition and audit and assurance experience. I have working experience with different accounting and finance sectors, including manufacturing, oil and gas, power and utilities. Um, and apart from this, I am also working as a trainer in a few organizations for the sake of professional development and CPTs. So this is my introduction. Okay, now I'm moving to the topic. And our topic, as I mentioned today, is borrowing cost, which is International Accounting Standards 23. So let's start. So this is our content or the topic which I'm going to cover today. We will be talking about the core principle, and apart from that, we'll touch base on the definitions, then recognition, as well as the eligibility of the borrowing cost, commencement of capitalization, suspension, cessation, and then disclosure requirements, and at the end, definitely question and answers, and next CPD session which we are going to arrange. So in between, if you have any question, you can stop me on these slides, on any particular slide, and you can also raise your hand so that we can move to the question and answers live. So if we want to make it more interactive session, rather I would be speaking only. So the core principle of IAS 23, which is borrowing cost, basically the borrowing cost which is directly attributable to acquisition, construction, and production of the assets. And it's not just an asset. We cannot simply say an asset or group of assets. It is only pertaining to this borrowing cost or the standard is which are, we call it qualifying assets. And the qualifying assets definition we will be covering in one of the slides. And further, the borrowing cost has a scope which is on its form and it's part of the cost of the assets. If this cost is not directly attributable to qualifying or construction or production of a qualifying asset, then that cost cannot be capitalized, and hence we have to expense out that borrowing cost. So this is the core principle, like directly attributable, then acquisition, construction, and production relating to, and then qualifying asset. So as I mentioned, the scope of this this international accounting standard is mainly on the borrowing cost, but it does not include actual or imputed cost of equity. If anyone can elaborate what is actual or imputed cost of equity, I can turn on the mic if someone would like to speak about it. Okay. So what is the meaning of imputed cost of equity? I can give you one example. For example, if there are preferred shares or redeemable preference shares which a company is also having, so the company would also be paying interest expense or interest cost on those preferred shares or redeemable preferred shares, though that cost cannot be capitalized if it is construed or become the part of equity. So let's say if those redeemable preference shares or if those preferred shares are part of only liabilities, those are basically only considered as a loan. There is no convertible option into an ordinary equity. Then we cannot capitalize such borrowing cost. Yes, we can capitalize the borrowing cost only if those preferred shares are considered as a liability rather the equity. So this is the exclusion from IAS 23. Further, the standard is not applicable um, uh, if those are basically if an asset is not a qualifying asset as well as the asset is measured at fair value. Asset is measured at fair value is I can give you example in case of biological assets. So this standard does not apply like the entity has an option to apply this standard on the biological assets as a qualifying asset, but they cannot basically directly choose the application of this standard. Further, if the inventories are measured, if inventories are manufactured or produced in large quantities on repetitive basis, normally those are not part of the IS 23 borrowing cost capitalization. For example, normal or if the company is producing any let's say wooden bed as a part of the operations. So it means they cannot capitalize the borrowing cost on those inventories. So we'll be covering the definition of qualifying asset in the next slide. So you will have a further clarity on that. So as we mentioned, what is included in the borrowing cost? Borrowing cost includes interest expense, normally on the loans, as well as finance cost. Finance cost is basically, or financial charges or finance charges is basically on or with respect to finance lease. So if you have any finance cost with respect to finance lease, so that can also be capitalized as a borrowing cost under this standard on a qualifying asset. And the next inclusion, what you can capitalize is exchange difference, which is arising on the borrowing cost because of the I can say functional and presentational currency or the currency in which the loan have been obtained. So, any questions so far? Okay, so we are moving further. So this inclusion includes, as I mentioned in the previous slides, the exchange difference is also part of borrowing cost to the extent if the exchange losses does not exceed to the difference between the cost of borrowing in terms of functional currency as well as cost of borrowing in foreign currency. So to that extent, we can also capitalize the exchange losses or the gains can be adjusted to the borrowing cost. So basically, it will be look upon into at the date of capitalization or the I can say the reporting date. These losses can be assessed and further reviewed. So now, what is basically qualifying asset? The qualifying asset is, as I mentioned, the inventories, but the inventories which are part of normal or routine operations of the company, those are not normally covered. For example, if a company is producing Coca-Cola, so they may not be able to capitalize the borrowing cost, because the inventories should have a qualifying asset definition. The qualifying asset is normally those are the assets which are really an asset that necessarily take a substantial period of time to get ready for the intended use. For example, Boeing is making a plane, so that Boeing plane, definitely it is not can be developed or can be constructed in a few days, or as a repetitive inventory. So for that, it requires a substantial period to get it ready. For example, the best example can be housing societies, or the in real estate or construction industries, where the real estate entities are producing the different houses or apartments. So those houses or apartments requires a substantial time to get it ready for the intended use or for the sale. So those kind of inventories are can be considered as a part of qualifying assets definition, but not as a bulk quantities inventory produced. So manufacturing plants, definitely those are qualifying assets. It requires a substantial period to construct and operate and convert into intended use any plant. Power generation facilities or intangible assets. Intangible assets, sometimes, yes, it take a lot of time to develop if the operator recognize an intangible assets in exchange of construction of services. In case of concession arrangement, then the operator has to recognize an intangible asset, and that could be a qualifying asset if the operator recognize an intangible asset in exchange for the construction services. So in that case, such borrowing cost can be capitalized. And investment properties, it's same like as I mentioned earlier, the real estate investments or housing projects or commercial projects that can also be considered as a part of qualifying assets definition. So any questions so far? Okay, so yes, sir has a question. So yes, Azhar, I can turn on your mic. Okay, so yeah, you can speak now. Yes, Azhar, you can speak. Okay, I think maybe Azhar has not turned on his mic, so maybe we can take this question at the end of the session. Yes, Azhar.
Yes, Mr. Salman, I am asking regarding this manufacturing plant. How is it as a qualifying asset as a manufacturing plant?
Normally, borrowing cost is always allowable to be capitalized in case of IAS 16 and IAS 36. So, like those assets, whenever any entity is going to construct a uh, new plant, property, plant, and equipment, so normally those property, plant, equipment cannot be basically constructed and converted into intended use in a in a year. So that's why for IS 16 and as well as for IS 36 as well as for IS 40, investment property, intangibles, as well as property, plant, and equipment, it is always be considered and always qualify for the definition of qualifying assets. So mainly, this qualifying asset definition has a particular guidance on the inventory side. So where, as I mentioned, the housing properties or flats or buildings, or as well as I have given example of Boeing. So those kind of inventories who where the substantial period is required to construct and prepare it. So for those, this definition has a really clarity. Otherwise, for property, plant, and equipment, intangible assets, and investment properties, there is a straightforward criteria. Okay. The next one is basically the assets which are basically falling assets cannot be considered as a qualifying asset. I have already explained financial assets and inventories who can be manufactured or produced over the short period of time, as well as the assets that are ready for their intended use or sale when it is required. Basically, let's say in a housing project, uh, a company, an entity has already acquired from entity B 5 housing flats. So those are already intended for use. So though on those assets or on those inventories, these borrowing costs cannot be capitalized. Yes, if those assets were under construction and then you have a basically right to capitalize the finance cost on those. So this is a clarification on the intended assets. We will also discuss it on the a few next slides. So recognition, this borrowing cost, which is directly attributable to the acquisition, directly attributable, or relating to acquisition, construction, or production of qualifying asset shall be capitalized as a part of the cost of the assets. So how much borrowing cost can be capitalized, it will be discussed on the next slide. Whereas other borrowing costs shall be recognized as an expense in the period in which that is incurred. So what is directly attributable? Directly attributable means the company or entity would have taken a specific loan for the construction or acquisition or production of that asset, and or there could be the general borrowing, like we can say pool borrowing to acquire such assets. So in that case, we how we can calculate the borrowing cost can be discussed on the next slide. But this is the criteria. The cost which is directly attributable can only be capitalized. Otherwise, that cost cannot be capitalized. So borrowing costs are recognized when it is probable they are result in a future economic benefit and the cost can be measured reliably. Now, measurement. If, as I mentioned on the previous slide, if the funds are specifically or borrowing which is specifically have been obtained or taken for the sake of obtaining or for the sake of construction and preparation of the qualifying asset, then the actual borrowing cost incurred during the period can be capitalized. But if for the sake of this, let's say if a company has taken a billion real loan or $1 billion loan, but over the period, this basically cash flow will outflow over the period. So during that period, the company also convert this fund excess fund into saving accounts, and if any income is generated from those saving accounts, that should also be netted off against this borrowing cost. So the borrowing cost is which is actually incurred less any income or temporary investment on those borrowing. So this is the phenomena. to calculate the specific borrowing but interest cost. And if the funds are generally used from the pool funds for the sake of obtaining this qualifying asset, then the borrowing cost will be determined by applying the capitalization rate to the expenditure of to the expenditure on that particular assets. And how the capitalization rate will be determined? It is a weighted average rate for the borrowing cost of the entity that are outstanding during the period other than that where you have a specific borrowing. So basically the concept is let's say company is financing a project of 1.5 billion US dollar. So let's say 1 billion they have taken up specific borrowing from the lenders, or let's say 500 million they are using from the pool. So on $1 billion, they will apply the specific borrowing formula or calculation, and on the general borrowing they will see how much finance cost or how much interest is incurred on the pool borrowing, and they can apply the weighted average rate of such general borrowing to see how much those borrowings would have been used for the sake of this particular assets. So the amount of the borrowing cost capitalized during the period shall not exceed the actual amount of borrowing cost. So as per the accrual concept, how much the cost has been incurred can only uh, be capitalized as a borrowing cost, but no future interest expense or outflows can be capitalized. This impairment is a little bit different topic, but it is also somehow relating to the borrowing cost. Let's say if the carrying amount of a qualifying asset uh, or the expected ultimate cost of qualifying asset exceeds its recoverable amount or net realizable value, and then you have to write down uh, the carrying amount of the assets, because of if its recoverable amount or net realizable value is lower than the carrying amount. So in such circumstances, um, we definitely would also be part of the impairment. We would also be expensing out our borrowing cost, which we have already capitalized earlier. So the next one is this is a little bit different flavor on the same topic. When we should start commencing the borrowing costs capitalization, when it should stop, or when it should be suspended. So the commencement means, let's say, uh, when this is very much important definition about the commencement of borrowing costs to be capitalized. When all these following, all it's an and condition, not or condition. So all the following conditions have been met, then we can start capitalizing the borrowing cost. Number one is expenditures are really being incurred on the assets, and secondly, borrowing cost is also incurred. And the third thing is it undertakes the activities to prepare the asset for its intended use. For example, when we are starting a project, so first we have to, let's say we are going to give a turnkey contract to one of the supplier of 500 million dollar worth. So before there are many steps of planning, like the entities must enter into the contract. They have to make the administrative stuffs ready. So it doesn't mean, and let's say company is also going for the lending, sorry, for the borrowing from the lenders. So all those administrative stuffs, when the company is basically preparing or managing, it doesn't mean they can start capitalizing the borrowing cost. So as I mentioned, the borrowing cost can only be capitalized when the actual expenditures are being incurred on that assets. Like they have placed the order to the vendors with regards to different parts of the plant, and the site has been under preparation, as well as the company would have withdrawn the loan from the either specific borrower or from the general pool, and they really the borrowing cost has incurred. And number third point is basically validating all the activities to prepare the asset for intended use. So this is the time period when you can commence the borrowing cost capitalization, and cessation means when we should stop. So capitalization of borrowing cost will be suspended during the period in which the will cease, in which the development of qualifying asset is suspended. So here I can explain, for example, if an asset is intended for use, let's say again, I can give example of a housing society or the house or flat. Let's say the house is basically its gray structure is ready, and then after that all the amenities has been installed, and it has been tested, but let's say certain decoration work is just pending. So it means the house is or intended asset is available for use or available for sales. So that is the point when the borrowing cost uh, capitalization should have been stopped to those particular assets. And suspension is basically uh, suspension is there are two types of suspension. There is a temporary suspension or intentional suspension. I can say, let's say the entity would have suspended the project intentionally, then they during that suspension period they cannot capitalize the borrowing cost. So the borrowing cost capitalization should also be stopped. But let's say suspension is the mandatory or basically mandatory part of the process to develop an asset. Let's say again, in case of housing societies, after the gray structure, let's say they for the paint work, they had the all other stuffs, or let's say the material they would have applied, it should first dry down, and they have to wait for 15 days, or any such scenarios where the suspension is mandatory to convert that asset into intended use or for sale. So in those cases, during the period of suspension, still you can capitalize the borrowing cost. But if the suspension is intentional or asset is already available for use, then in that case, no, this borrowing cost capitalization uh, should be stopped, and you cannot further capitalize the borrowing cost. So if any question on the commencement, cease, and suspension, this is very much important to understand. Okay, so we have discussed these slides in detail, but I can take you through quickly. Commencement of capitalization, as we mentioned, the cash payments have been made or assets have been transferred or interest-bearing liabilities are assumed, less any progress payments and grant received. So borrowing cost incurred means use the carrying amount of assets to apply the borrowing cost rates. It's basically for the sake of calculation of borrowing cost capitalization. Activities in progress to prepare the assets. These includes like technical and admin cost prior to the construction. So that is activities that include the progress Okay, include the technical and admin cost prior to the construction, but it excludes the assets ready for the use but not in production. And cessation at substantially all the activities necessary to prepare the asset for intended use are completed. Physically completed or minor modification is outstanding, still it will be considered it's substantially completed. And another important concept here is, let's say, if the different qualifying assets have been produced or would be producing, then we have to see for each asset when the borrowing cost should be ceased. For example, uh, in a in a in a multi-story complex where there are 50 houses to be built, and each house is although this or the whole complex is considered as a qualifying asset, but even the each house can also be considered as a qualifying asset. And whenever any particular house is completed and available for intended use or sale, then we can stop the borrowing cost on that particular assets of, I mean, those particular houses, and remaining houses which are under construction, still we can keep capitalizing the borrowing cost. Suspension we have already discussed. The activities necessary to prepare the asset for an intended use. Then this is we can still keep capitalizing the cost, but not when the technical or admin works are being carried out, or when or it also excludes the temporary delays. Completion in parts we have already discussed. If any similar, let's say I have given the example of housing societies. So if the similar assets are being produced, so whichsoever asset is available for intended use or sale, then we can stop capitalizing the borrowing cost on those particular assets. So when an entity completes the construction of qualifying asset in parts, and each part is capable of being used while construction continues on the other parts, so the entity shall cease capitalizing the borrowing costs when it is completely or when it completes substantially all the activities necessary to prepare that particular part for its intended use. Disclosure requirements. This is basically the company or the entity has to disclose the amount of the borrowing cost capitalized during the period. Normally, the entities are disclosing this disclosure under property, plant, and equipment, along with descriptive notes. And the rate has been used for the capitalization of any eligible or qualifying assets. So the amounts and the rates we have to disclose. So this is it from my side. And now this is a very small topic, but interesting and important. So if anyone has any further question, we can open up the mic, or you can type. So if there is no question, then we can wrap up the session. Please raise your hand if you have any question. Okay, it seems, okay, one question is there. Okay, so what is the difference between IAS 16 and 23? IAS 16 basically talk about the component of cost as well as the useful life. Like it is mainly, addressing the property, plant, and equipment. And property, plant, and equipment includes, during the construction type, what which kind of components of cost we can capitalize, which we cannot. Then useful life of the assets, as well as the I can say somehow it is also touching the impairment on those property, plant, and equipments. Also, what kind of model we can use for the sake of capitalization. It is cost model or evaluation model. So IAS 16 is mainly addressing all the concerns with regards to property, plant, and equipment, including the useful life, or even the revision in the useful life and everything regarding that. This borrowing cost is very much particular to the interest cost, which should be capitalized part of the property, plant, and equipment. So interest cost, or which is basically IAS 23, it has an impact on IAS 16 on property, plant, and equipment, as well as it has an impact on the recognition of intangible assets as well as the investment properties. So this is the difference between IAS 16 and 23. But IAS 16 it has a large scope on property, plant, and equipment or fixed assets. Okay, so any other question, you can raise your hand. Okay, Mohsin, Salim, I have opened up your mic. Yes, you can turn on your mic and you can speak. Thank you.
Hello, can you hear me?
Yes, now I can hear you.
So it's a very, informative topic. You are giving us information about IAS 23.
Okay, thank you so much.
And IAS 23, if you have any, for example, borrowings like interest, you have like loan interest. So it's also apply to the IAS 23 borrowings.
See, what I understood is you are saying, let's say your company has a different loans.
Different loans that we are going to use for the qualifying assets.
Yes.
Let's say you are talking about the construction, for example. So we are going to make a fixed asset, and if there is any interest on loan, then that would be also directly attributable, and that would be capitalized.
Yes. Okay. So
Okay,
basically, if there is any asset which you are constructing, which is a qualifying asset. Normally, as I mentioned, property, plant, and equipment is a qualifying asset. So you can capitalize the borrowing cost to the extent as I mentioned in the previous slides. Like I have mentioned, if there is a specific borrowing or there is a general borrowing for these assets, as well as let's say if there is, as I also mentioned, the commencement period and cessation period, you can apply all those particular
all the conditions would apply.
Yes. You can capitalize, but the day when asset is ready for use, you cannot capitalize this interest expense. Then you have to start charges to profit and loss.
Okay.
So one concept I was maybe I'm adding more here. Let's say if the group of companies, if a holding company has given the loan to its subsidiary for the sake of construction of a qualifying asset, can we capitalize such borrowing cost This is not about this is not to you, Mohsin, but generally I'm asking to everyone if anyone has an opinion about it.
I think my answer is yes, maybe.
Okay. So anyone else? Okay, other than Mohsin, if anyone else can. Okay, so basically, if an entity has given a loan, a holding company has given a loan to its subsidiary for the sake of construction of any property, plant, and equipment, but but in the consolidation, that entry will be eliminated, by the way. But if the holding company has taken this loan for the sake of subsidiary assets construction, yes, then such finance cost can be capitalized. Okay, so the next question, can we have a session on IFRS S1 and S2? S1 and S2, yes, we will have, but could be somewhere in September. Okay, so I have no further question, so I will try to wrap up the session in a sense that you have my contact detail on the screen, which you can use to ask any question on IFRS. Our next topic will be either IFRS 18, which is basically the extension of IAS 1, or will select to choose financial analysis as a topic. So I will be presenting myself early July 2024, and members who have joined here, and those have registered via IP, Institute of Public Accountants of Australia. So there is a reminder for them to renew their membership for 2024 and 25, like from July 2024 till June 2025. So that's it from my side, and thank you so much for joining everyone this evening. Thank you so much, and bye bye. I think I have one question now. Okay, thank you. Bye.